Hello, in this lecture we're going to record the transaction of the owner depositing cash into the business. The owner is going to deposit $100,000. Here's the owner, here's the cash, there's the business. It's going from the owner into the business. We're going to record the transaction, the journal entry on the left-hand side, and then post that in a shorthand fashion into the trial balance over here on the right-hand side. Questions I'm always going to ask for every transaction is first, is cash affected? In this case, it is affected. Cash is going into the business. Is it going up or down? It's going into the business, so cash is going up. And does cash have a debit or credit balance in it normally? What's its normal balance? Cash is normally a debit balance account because it's an asset, and pretty much all assets have debit balance normal accounts. Then we just have to memorize that in order to make something go up, we have to do the same thing to it as what it is. Cash is a debit. Therefore, we're going to do the same thing to it, which is debit it to increase cash. So how do we increase cash? We debit it, because assets have a debit balance, and we're doing the same thing to it. If we post that then to the trial balance, post this half of the journal entry, we would say, okay, cash is at 0. We're going to debit it here, represented by no brackets in this case, and that's going to bring the cash balance up, of course, to $100,000. What will then the credit be to the credit half of our journal entry? Well, the owner's the one that put it in there, so we're going to have to put it into owner's equity. So the credit's going to go into owner's equity, and if we post out that second piece, then owner's equity is going to go up in the credit direction. Notice we're representing the credits over here with brackets, meaning the debits have no brackets, the credits have brackets, so if we subtract them out, we would end up with 0. That's how we're going to have the debits equaling the credits within the trial balance, and we're increasing the capital account by the $100,000. What happens to our account equation then? Well, assets went up and liabilities, nothing happened. Equity went up. Assets equal liabilities plus equity. Asset half went up. The equity section went up. If we look at the net income, notice there's no impact on net income. Remember, everything down here in the blue, including the equity account and all the revenue accounts, are part of the equity section. Net income is calculated as revenue minus expenses. No impact on revenue minus expenses because it went directly into the capital account because the owner is the one that put the money in at this time. That means that we have assets at this time of $100,000, and those assets, of course, are all owed to the owner at this time of the $100,000.